So let's talk about chapter 13 a little bit. It might be, I believe, we're going to cover notes, present value concept. Yes, it's going to be a little bit hard chapter possibly. We are going to look at the nature of bonds and related terminology. We are going to learn accounting for bonds payable, whether issued at par or premium or discount. Effective interest rate amortization method that will be accepted by GAAP. And also, it's very important if you want to do CPA examination. Bonds issued between interest dates, bonds retirement and fair value measurement of the bond, and analysis, commitments, and leases. A very comprehensive chapter. So buckle up. Let's cover some portion of this together. In regards to chapter 13, let's see. Here is the tables. This is what I want you to make sure you know where the tables are, because when you are trying to calculate the present value, you need to look at these tables. And I'm going to open it right now here, so you have a very good understanding of these tables for chapter 13 in regards to calculating the present value. So there are some tables that are talking about future value tables, like lump sum, like $1 amount, one specific one-time dollar amount. You are also future value of ordinary annuity. Ordinary annuity, it means series of same payments paid at the end of each period. Series of same payments paid at the end of each period. But annuity due is similar to ordinary annuity, but the difference is series of same payment, but due at the beginning of the year, beginning of the period. So this one is paid at the end of the year. This one is due at the beginning of the year. But both of them are series of same dollar amount payment, okay? Future value, we're not gonna look at it too much. Our focus will be on the present value. And here again, you have three important tables for present value. Present value of $1 one time, present value of ordinary annuity, which is series of payment at the end of each period. Those two tables will be used heavily in this chapter 13. So let's go to first one. Long-term notes and present value concept. So this is a long-term note, which is you borrow $10,000 and you record $10,000 note payable. And let's say this is a 5-year note. That's why we call it long-term, and 8% annual interest rate. Borrowed in 2013, October 1st of 2013, let's say. By end of the year, December 31st, you need to recognize the accrued interest, which we learned already, right? So the $200 accrued interest, it is $10,000 borrowing times 8% times 3 months out of 12 months. And that's the interest payable. At the end of first year, you need to, and every year after that, you need to pay the interest expense and interest payable, whatever has accrued during the last 12 months, which in this case, 200% accrued already in the first 3 months, and $600 interest expense accrued in the last 9 months. Total $800 interest on $10,000 borrowing based on 8% annual interest rate. So far, so good on this. Recording the liability, recording the interest liability in the middle of the year because of preparing financial statements, and then payments of interest on the annual basis. Remember, the principal will be paid in 5 years. So 5 years from that time in 2018, September 30th of 2018, the company needs to pay $10,000 liability for the note and $800 interest for the last year of borrowing, year 5. Out of that, $600 belongs to year 5 in 2018. $200 belongs to last 3 months of after year 4, from October to December, and $10,000 is the note payable. Those two liabilities are closed. A $600 expense is recognized, and cash will be credited to close the liability. To understand it better, I suggest start from here, post it to the T account on your scratch paper, and then post the next journal entry to the T account, and then finally post this to the T account so you can have a visual understanding of this. Is there any question for me before I move on? Okay. So what is future value? Future value or a compound interest amount that a current payment or stream of payments will grow in time, includes interest on previous interest based on frequency of compounding. Compounding is very important. How many times is going to be compounded? Is it compounding on the monthly basis, daily basis, annual basis, quarterly basis? So that is the interest on interest. It is very important to know that it will increase the dollar amount, future value, and how many times it's going to be compounded, again, depends on the agreement. Also, future value depends on the amount to which an interest earning amount is expected to grow over a stipulated time period at a given interest rate. So the interest rate is important for future value, and the compounding period is also important. So let's look at an example here. So here says if $1 is invested for 1 year at 10% annual interest rate per year, it will grow to $1.10. Agree? 10% of $1. So it will become $1.10. This is calculated by multiplying $1 by 10% and adding this 10 cents to the original amount. So it ends up to be $1.10. Now in year 2, the $1.10 will also be, multiplied by 10%. So this is a compounding on annual basis. So at the end of the year, $1.10 will be multiplied by 10% again. So for year 2, the total amount investment will end up to be $1.21, which is $1.10 times 10%, which is 11 cents. 11 cents plus $1.10 from the previously annual compounding. Now it's $1.21. And this happens again and again and again. So this is annual compounding, and you not only earn interest on your original $1, but you also earn interest on your interest that you already earned. So compounding simply means that the investment is growing with accumulated interest and earning interest on previously accrued interest. The contrast to compound interest is simple interest. Simple interest is a calculation that do not provide for a periodic inclusion of accumulated interest into the base on which interest is calculated. That means you never earn interest on your already earned interest. You only earn interest on your principal, and that's it. So in that way, you make much less future value compared to a compounding interest method. And this is a formula for compounding interest, which is 1 plus I power n. I is the annual interest rate, n is number of period, and 1 plus I is power of n. But you don't need to memorize that. Okay. Let's say here gives you an example. Here says $1 with interest rate of 6%, invested for 5 years. It will grow to become $1.34, $1.34. And of course, if it's $1,000 invested in 5 years with 6%, it will end up to be $1,338.23. This is determined by multiplying the derived factor times the amount of interest in this formula. In order to calculate this, also you can use the factor in the present value table. So I'm going to show you right there in a second. So here is the future value, how much it will be if it is, for example, let's see, it is $5,000 invested for 10 years at 4%. What would be the future value of this $5,000 after 10 years? So if you invest $5,000 today, and after 10 years, 4% interest, how much will that investment become? So let's look at this one to see what the factor is. Here is the factor, obviously, but I want to show where you can find it, okay? So let's look at this one example, 5,000, 10 years, 4%. So amount is 5, I is 4, and investment N is 10, okay? So you can go to future value of one-time investment. That's why you go to lump sum. You're not going to put annual 5,000. That's just one time 5,000. So go to annual lump sum, I mean, future value lump sum. Okay, and the interest I was 4, so here is I, N was 10, here N is 10, right? 10, N is 10, I 4. That's 1.48024, 1.48024. 1.48024, and that's times 5,000, and that ends up to be $7,401.20 after 10 years of investment. So as you see, compounding is it's a very strong factor for creating an investment. However, in regards to bonds, we are looking not in future, but we are looking at the present value of that bond. How much a bond will have a value today, present value. So present value is a calculated value today of the amount received in the future based upon an assumed interest rate, and also known as discounting, determines the current worth of cash to be received in the future. Because when you issue bonds, let's say it's a 10 years bond, the bond will be paid back to investors in 10 years. Okay, but based on the interest rate of, let's say, 5%, then how much that bond worth today? Okay, and you have to calculate it based on present value. And here is the formula for the present value, which again, normally you don't need to, I don't memorize this. I'm not good in memorizing, but I'm good at how to find the value of that, present value of that investment, let's say, or bonds or whatever it is. So for example, $1,000 to be received in 5 years when the interest rate is 7%, is presently worth $712. So if I want to give you $1,000 5 years from now with the 7% annual interest rate, that $5,000 today worth $712.99. So how do I know that? Here, 5 years, N is 5, I 7. N is 5, I 7. So you go to the table, not the future value, but let's see if I have other tables here somewhere. Lump sum. And here I was 7, N 5. Okay. So present value of $1, I 7, N 5. And the factor is 0.71299. So if you multiply 0.712999 by $1,000, that will end up to be today's value at $712.99. Make sense? How to work with the tables? And annuities, I told you, those are series of payment. Now annuities can be annuity due or ordinary annuity. Series of payment due today is annuity due. Series of payments paid at the end of the year is ordinary annuity. So here, if you want to use future value, today is $1 times the factor of future value based on N5, I 5%, I 5%, N5. So you can, one way is using the lump sum table, and multiply this 5 times. So this is a hard way to do it, long way to do it, but you can do it if you want. So if you go to $1, future value of $1 once lump sum payment, and look at the I5 and N1, N2, N3, N4, and N5, you will see all these factors, all these 5 factors for year 1, year 2, year 3, year 4, and year 5. And just like, for example, present value, right? And you say 5%, okay, this is 5%. This is year 1, year 2, year 3, year 4, year 5. So if you pick up all these 5 factors and multiply with your dollar amount, you can calculate the present value. And the opposite is also true for future value. So if you go to future value table and multiply all those 5 years times for the 5% interest rate, okay? And multiply one by one, and then add them up, you will get your future value of $5.80. But this is too long to do it. It takes forever, okay? But in order to make it easy, because all those payments are same thing, so you don't waste your time in using present value of $1 table or one lump sum table, you will use the ordinary annuity table. And then you just multiply once. So you go to future value, ordinary annuity. Why ordinary annuity? Because the $1 is paid at the end of each year. But if the payment is paid at the end of each period, beginning of each period, then you use annuity due. Here, let's say, go to this future value table, and let's say 5%, year 1, year 2, year 3, year 4, year 5. And let me see, what was that again? At the beginning here. You see, it says at the beginning of each year, $1 investment at the beginning of each year. So that is annuity due, not ordinary annuity. So this is not good. This is ordinary annuity. So we have to go to annuity due. So let's go to future value of annuity due, because at the beginning of the year. So if we go to that table and we go to 5%, and here is year N1, N2, N3, N4, and 5. Pick up all these 5. Okay. The first one is 1.05 and then 2.15. Okay, here. 1.05 and let me see. Okay. This was using the lump sum, okay? But we want to do it easy way, not like this, right? I already covered that. I want to tell you, okay, instead of doing this five times, I want to do the same thing, but just with one. So I use the annuity table. So annuity table, and here it says beginning, right? Remember, I came back here, it says beginning. Okay, so in order to get the same results, I go to future value of beginning, which is annuity due, and I go to 5, I5, and 5. It is 5.80191. Just pick up that number, that factor, and then multiply that with $1. And the answer will become 5.80192. So instead of doing this 5 times forever, I do it in 10 seconds. $1 times that factor, N5, I5, and I will get the same answer. You see how much easier it might be? Okay. There is another issue here. It's trying to show you. It says present value of an annuity, today's value, equals to the number of payments times annuity present value factor. Okay. One thing that you need to make sure to understand, what type of annuity it is. Is it annuity due or ordinary annuity? Because the tables is different. So that's all you need to know. But if the payment comes at the end of each period, then it is an ordinary annuity times annuity present value factor, and that ends up to be the present value. Now, if you want to calculate how much is the payment if you borrow money, that means you are looking at present value of the borrowing, which is here, present value of the borrowing, and then divided by factor, it gives you the payment. Make sense? That's how you know and how you can calculate your loan payments. All you need to know how much is your loan amount, present value of your loan amount, which is whatever it is today, and what is the annuity present value factor. What you divide that. So let's say annual payment to satisfy $100,000 5-year loan at 6% per year, how much payment it might be. So we know the loan borrowing is today present value is 100,000. That's the loan. Payments we don't know, but we know the factor is 4.21236. Where's the factor coming from? So you go to present value of I assume this is a borrowing and you have a payment at the end of each year, let's say. Yeah, end of each year, let's say. So you borrow $100,000 and this is a 5 years borrowing, and the payment, including principal plus interest, will be due at the end of each year. So that should be present value of ordinary annuity, end of each year, end of each period. And that was 6%, 5 years. I6N5. Okay, I6, present value of ordinary annuity, I6N5, right there. 4.21236. So you multiply with that factor by payment, but payment we don't know. So 100,000 divided by 4.2, and that gives us annual payment of $23,739. So if you borrow $100,000 with a 6% interest rate for 5-year loan, that loan will have an annual payment of $23,739. And here is the idea. So here you are borrowing $100,000, and your payment is every year is $23,739, right? And your original borrowing amount is 100,000, and annual interest rate is 6%, right? So 100,000 times 6, that's $6,000 interest expense for the year 1, right? 6,000, but the payment is how much? 23,000. So 23,000 minus 6,000, that is 17,739 reduction in principal. So 100,000 minus 17,739, end of the year principal is 82,260. Year 2, your principal is 82,260. 6% of 82,660 is 4,935, but you are going to pay again the same $23,000. So 23,000 minus 4,900, that will be $18,000 reduction in principal. 18,000 minus 82,000 gives us 63,000 leftover balance. 63,000 goes to year 3 times 6%. It will be interest expense of 3,800, but you're gonna pay still $23,000 no matter what. So 23,000 minus $3,800, that gives you 19,900 reduction in principal, and 19,009 minus 63 principal balance at the end of the year 3 will be 43,000. And you do the same thing for year 4, year 5, and then your principal ends up to be 0. Your payments are always same. Your interest is very high at the beginning because the principal is high, but your interest expense keeps going down because your principal is getting smaller and smaller. Any question, please? Perfect. Looks like everyone is happy. Okay, what's the journal entry again? We borrow money. That's cash, $100,000 deposit in the debit side. Note payable will be recognized for this liability. This is a 5-year note. At the end of year 1, we are going to pay the first payment. A portion of it will be interest expense according to this schedule of loan, $6,000. And the other portion will be the note payable reduction on the principal. Very important to be able to calculate this dollar amount. For year 2, the interest expense will be only $4,935 according to that schedule of note payable. So 23,000 minus 4,900, reduction in principal will be plug in 18,804. Year 3, same thing. Year 4 and year 5. And you can also calculate same thing in Excel using, let's say, a formula for payment, for future value, for present value. Everything will be available in Excel to calculate whatever we used for using tables. Okay, so let's say for payments, you say, okay, payments, you go to financials, then go to PMT, click on the PMT, and then you will see something like this. It says rate, you enter whatever the annual rate is, let's say 6%, 0.06. How many years? N is 5, enter 5. Present value of the loan is 100,000. But as soon as you put this 3, this box here shows 23,739. You click OK, and the 23,739 will pop up in this cell, which is your annual payments. So the bonds payable by itself, it's an obligation divided into transferable units requiring the issuer to make periodic interest payments and then in eventual repayment of the face amount. That means the company issues bond and investors, they buy the bond certificate, which is in thousands, $1,000 each certificate. And they get normally semi-annually, twice a year, they get interest payment every 6 months for the amount of investment they did. And at the end of the maturity date of the bond, they will get the original investment back. So let's say you invest in a bond. So you have $1,000, you invest your $1,000 in a bond. Every 6 months you get, let's say, if the annual interest rate is, let's say, 10%, every 6 months you get $50, which is 5% of 1,000. So every 6 months you get $50 check. And let's say this is 10 years bond. So after 10 years in the maturity, at the maturity, you get the original $1,000 investment back in your hand. So it's a good way to invest. We have corporate bonds, we have government bonds, and we have several type of bonds here that you need to read it anyway, but it's a secured bond. It's a bond that is secured with a specific asset as a collateral. However, we have also debentured bonds. They don't have debenture bonds, means bonds that they don't have collateral. It's just based on faith. And most of bonds nowadays is based on faith, which means debenture bonds. Coupon bonds is a bond that has detachable coupons that are exchanged for interest payments. Historically popular, but nowadays you don't see coupon bonds, so-called. So there's no more coupon. The bond interest will be deposited into your investment portfolio automatically. Registered bonds are bonds for which ownership records and maintained, and interest is paid to the registered owner. So it's as it says, it's a registered bond. Sinking fund bond is a bond issue that requires periodic setting aside a money into a separate fund to provide for eventual repayment of the bond at the maturity. And this is kind of common. They use this. This extra fund will be like a saving account, and every month or every quarter or every 6 months, they put something aside, whoever the issuer, and because let's say 10 years later they need to pay the bond, they have already the fund available. So it's just like a saving account. Serial bonds are bonds that issue at multiple repayment dates instead of just one specific maturity date. So that's another way to mature a bond and pay the original face value back to investors. It might be in a series of dates. It's not just like exactly at 10 years or 20 years. Convertible bond, those are bonds that may be converted into holder stock of the issuing company. That means, let's say a company, corporation, issue a bond, and after a specific time or period, let's say whatever it's in the agreement, the investors, they can convert the bond certificate into common stock. Of course, it's optional, but that's something that has a benefit for investors, because they might think, okay, if I convert this to stock at this moment and sell the stock, I might have more gain compared to just sell the bond. Callable bonds are bonds that can be called upon an option by the issuer. So issuer has the option to call the bond back after a certain time, let's say, and pay the original investment back to the investor and say, thank you so much, and this is your original investment, and I don't want to have this bond anymore outside because I have cash, I can pay it off, or also I want to save on an interest expense that I pay every 6 months. Since I have cash available, I want to call back the bond. So it's a callable bond. Here says bonds that cannot be paid off earlier are sometimes called non-redeemable. Non-redeemable bonds are a bond that cannot be paid off before scheduled maturity. That means the corporation cannot say, oh, I'm going to pay this off. They cannot do that. But callable bond, they can. They can call it after the certain date that is in the agreement. Okay, that's fine. You can read all this stuff, but let's go to the technical part of it. Okay, so here is the technical part. So how do you issue a bond? At what price? Remember two things that it's very important. One thing, every bond has an interest rate. That interest rate will be only used once when you are calculating the payment. The payment is normally every 6 months or once a year, but normally it's every 6 months, semi-annually. So bond interest rate, you only use once. Don't forget, bond interest rate, you only use once to calculate your payment. That's it. After that, every other calculation for face value of the bond, issue price calculation, everything else will be based on market interest rate. And what is the market interest rate? Market interest rate is an interest rate that is good and fair to this type of corporation at this moment of time. Make sense? Based on corporation risk calculation, ratio analysis, and everything else in between, every corporation will be assigned a specific market rate. It's just like me and you. If I want to buy a house, if they check my credit history, they offer me 3%, 30 years mortgage. But let's say someone else wants to buy the same house, they check his credit history and they offer him 3.5% interest rate. Okay, why? Because my credit history maybe is better than the other guy. So the other guy pays 3.5% interest rate because his credit history is not as strong as mine, but mine is strong, so I get 3%. Same thing on a bond market interest rate. Market interest rate for every bond, for every corporation, for every issuer is different, but it will be whatever it is. And everything will be calculated based on market interest rate. The only moment you use the bond interest rate is when you want to calculate payment. So the bond interest rate might be, let's say, 8%. That means the bond is paying 8%. But the market interest rate might be anything besides that. Might be 8%, might be 10%, might be 6%, whatever it is. So you use the bond interest rate to calculate the payment. Everything else from that point on will be based on market. Don't forget that. So here we have three scenarios, possible scenarios. One of them is issuing a bond on its face value or par. That means the bond interest rate and market interest rate is same. So here is market 8% and bond is also 8%. So both of the interest rate are same. That means the par value, this bond will be issued at par. That means on face value. Whatever is the bond, that will be the issue price. So if the bond is, let's say, $1,000 bond, $1,000 bond with the same market interest rate equals to bond interest rate, that bond will be issued at exactly $1,000. However, let's say the bond is paying 8%, but the market is paying 6%. Why is that happening? Because the reason is the moment that they decide to issue the bond and print the certificates and everything else, that was at that moment, they think, okay, let's say that we're gonna pay 8%, and that's fair. But by the time every paperwork is ready for the bond to be issued, at that moment, you see the market interest rate for the company goes to 6%. They're not going to throw away those certificates that they printed already. That's fine. They're going to just use the same certificate that is printed and ready, all the agreements ready, everything ready. They're going to use all that paperwork. All they're going to do is just issue the bond in a form of, let's say, premium. Why? Because the market fair interest rate for this type of company, the market rate for this type of company, the fair interest rate is 6%. However, the bond is paying 8%, right? So if bond is paying 8% and market is 6%, so bond is paying too much. And because the bond is paying too much, therefore the bond will be issued at a premium, and they will ask investors to give them a little bit extra money because the bond is paying premium interest rate. However, if the bond, let's say, is paying 8%, and the market all of a sudden at that moment that they're going to issue is 10%, so 8% is too low, right? And who's going to invest in a bond that is paying less than it's supposed to? So the market is 10, but the bond is paperwork is on 8%. So at that point, the issuer will issue the bond at a discount and will ask investors to pay less for the investment, but they get the original face value of the bond back at the maturity. Make sense? So that way, every investor will get exact interest rate equals to the market, no matter how much bond is paying every 6 months. Make sense? So in order to understand it, we go with this first, and then I will show you an Excel that I just prepared to give you a better idea. Okay, so this bond is issued at has an interest rate of 8%. 8% every 6 months is 4%. 4% of $1,000 is $40 investment. So if this bond is issued at $1,000 every 6 months, the investor will get $40. At the maturity, let's say 5 years from now, this is a bond for 5 years. Yes, 5 years here, 10 periods. You see here, because it's every 6 months, so 5 times 2 is 10, so 10 periods. So this is at the end of 5 years, the investor will get $1,000 back. Up to here, we are good. So we have two numbers to calculate the present value of the bond issue price today. In order to calculate this, I think you remember via series of payment, we call it annuity. And because this $40 is paid at the end of each 6 months, then it is ordinary annuity, not annuity due, ordinary annuity. So ordinary annuity, and I want to understand what is the present value of this $40 paid every 6 months for 5 years. Today, I use the present value of ordinary annuity table. Okay, present value of ordinary annuity table. Present value of ordinary annuity table, 4%, period 10. Here, 4%, 10. So I go to present value of ordinary annuity table, 4% every 6 months is 8% is for a year, divided by 2 is 4%. And every year you get 2 payments, so 5 years times 2 is 10. So here is 8.11090, and that's where 8.11090 comes from. And then you multiply that to $40, and you get the present value of those payments today based on market interest rate of 8%. It will be $324.44. And then maturity value for $1,000, this is just $1 one-time payment, right? Just one-time payment. So you go to present value of $1 one-time payment. Okay, $1 one-time payment. Let's go to that. $1 one time here. $1 one time lump sum. Okay, present value of $1 one time. And here is $1 one time, 4%. That's the 4%. And here is 10. So that's 0.67556. Okay, right there. And that will be 0.67556 multiplied by $1,000. The present value of that $1,000 later on, after 5 years, today will be $675.56 based on market interest rate of 8%. And then we add those two numbers that we calculated together, and this is the face value of the bond that will be issued. So we call it bond will be issued at par, or bond will be issued at face value, which is exactly $1,000. However, here, if you look at it, if it is, let's say the market interest rate is 6% instead of 8%. So every 6 months, 6% divided by 2 will be 3%. 3%, so you're going to look at the 3% present value table for annuity to get 8.5320. And also you're going to look at the 3% $1 one-time table to get 0.74409, which I did show you on this one. So you got the idea how to do it. And then you multiply that factor by the payments, series of payment, equal payments, and you get the present value. And then this factor multiplied by 1,000, you get that present value. And then you add them up. So the bond will be issued at a premium. And why is going to be issued at premium? Because they tell to investors, listen, the market interest rate for this type of bond is 6%. However, the bond is paying 8%. So you need to pay today $85 more, $1,085.30 to invest in this bond, but you will get your $1,000 back at the end of maturity date. Same thing here. This time the market interest rate is 10%, but the bond is paying only 8%. That's not good. So the bond will be issued at the discount. So you get the present value of ordinary annuity table. I5, 10 divided by 2 is 5. I5, N10, and you get the factor from the table. And this one, present value of $1 one-time table, I5, N10, and you get these factors. So just to show you one more time here, here is the present value of $1 table. You go to the 5%, I believe, and 10 is 0.61391. 0.61391. And multiply that with the lump sum maturity payment of $1,000, and you get present value of $613 plus the present value of the payments gives you $922.78. So in this scenario, they tell to investors, because the bond is paying only 8%, however, the market interest rate for such a bond is 10%. So at this moment, just pay $922.78, and you can buy the certificate. And at the end of 5 years maturity date, you will get your original $1,000 back. So they pay less, but they get the $1,000 back. Why they pay less? They pay less because they say keep the remaining, let's say $80 or $78 in your pocket as a form of prepaid interest, because the bond is not paying enough interest. So here we let you keep the $78 in your pocket as a form of prepaid interest. However, this prepaid interest for the corporation is also, who is issuing bond, it's also prepaid interest. That means the corporation cannot record this something other than that. The corporation will record this as a discount on a bonds payable. And then it will amortize that during next 5 years. If there's a premium, so here the corporation will get $85 extra, you see here, from investors. If in a normal situation, you might say, oh, this $85 extra is some type of income, right? Because you charge people $85 extra. But the company cannot record it as an income or anything. The company will record it as a premium on bonds payable, and then they will amortize it during next 5 years. So they record less expense. So they, in this scenario, they will record less interest expense in next 5 years because of this $85. And here, because they got less here, like $78 less, they will record a little bit higher interest expense every 6 months and amortize that discount that they offer to investors at the beginning. So here I have a Excel for you, just so you see the same thing. So I put it like in the same way that we were just talking about it. Here is an issue at price, which is a face value $1,000 bonds, pays 8%, and market is 8%, and it's a semi-annually payments. And that's why I, instead of 8%, is 4%. So here I can say, let's say 8% divided by 2. 0. Let me try this, 0.8 divided by 2. Let's see if it works like that. No, I have to put, it's okay, let's just put it for now, 0.04. Okay, so that's good enough. So you got the idea why the I is 4%, because it's 8% divided by 2, because it's semi-annual payments. N is 5 years, but 5 years times 2 is 10 periods. N pay 10. Payment is $40 because the interest is $40, $1,000 times 4%. So $1,000 times 4%, that's $40 payments every 6 months. The maturity date, face future value of the bond at the end of 5 years is $1,000. That's the future, and that's how you calculate the present value, which is let me just do it one more time in here, for example. So here we go. You go to formulas, you go to financials, and then you go to PV, present value. Okay, the rate is that box. Period is N, 10. Payment is 40. And future value is 1,000. And okay. Type, let me explain this one. The type, because it's very important, because it's ordinary annuity, that means payments will receive at the end of each year, each 6 months, then you leave it either here says pay at the end of the period, which is ordinary annuity, then either enter 0 or just leave it blank. Okay. If it is annuity due type of payments, that means the first payment comes in today, then then you have to type here 1. But since it's ordinary annuity, I'm just going to leave it blank or just type a 0. And here I see already my answer is 1,000, and that means $1,000 will be paid by investors today for the bond, and they will get a $40 every 6 months payment. Same thing here. If I want to see if the bond is paying 8% and market is only 6%, so this will be issued. That means the bond needs to be paid more, but pay less because market is 6, but bond is paying right now too much. So because the bond is paying too much interest, then at the issue time, they will ask for a premium. So if I want to calculate that again here, you go to financials, you go to present value, and then rate, just click on 3%, click on period, then click in this box. For payments, either type it, it's fine, or just click on that box. For future value, either type it or just click on this box. And type, leave it 0 because it's ordinary annuity. And here is the explanation, okay? And the answer is 1,085.30. So you can just click on enter, and that's how it will be calculated. Same thing here. If the bond is paying 8%, however, the market is 10%, so the bond is not paying enough. So in that case, the bond will be issued at a discount. Any question? Let me know, please. Okay. Now here is issuing a bond at par. The journal entry will be collecting the cash from the investors, debit $100,000, and bonds payable will be 100,000. So here it says the company issued 100 of its 5 years 8% bond. As I said, every bond is in increments of 1,000. So hundreds of 100 bonds, that means 100 of times 1,000. That's 100,000. Then every 6 months, the company will pay the $4,000, which is the interest, exactly 8%, and cash will be credited to pay the interest expense every 6 months. That will keep going on for next 5 years until 5 years later, when the maturity comes in 2000, let's say 25, then the company will only pay the $100,000, the maturity face value of the bond in the maturity, and that's it. That's end of the bond. However, this is very easy, right? But when it gets issued in a premium, then it gets complicated, because now the cash is collected $108,530. As we said, the issue price was what? The issue price was $1,085.30, right? So that's 108,530. Premium is 8,530 premium on this $100,000 bond, and bonds payable will be 100,000. So now this premium, it's extra money that the company received. And normally you're going to say, oh, this is revenue or something, right? But no, we're going to keep it in a T account, call it premium on bonds payable, and amortize it every 6 months to record less interest expense. So instead of recognition of revenue in here, we're going to recognize less expense in here. And that will be $4,000. Again, every payment cash every 6 months for the bond. But the interest expense will be less. It will be $853 premium amortization, and interest expense will be only $3,147. Now, how do I know it's 853 amortization? Because I use straight line method, 8530 divided by 10, it's $853 premium amortization. At the end of the 5 years, all this premium has been amortized. It's now zero. Only thing is left is just to close the bonds payable. So I pay cash and bonds payable will be closed. Okay. Questions? You're good?
I have a question. Just premium on bonds payable. Our cheat sheet here says it's a liability adjunct account. Is this, can I think of this very similar to like an allowance of some kind, or?
No, it's liability. Let me tell you why it's a liability. Let's say today, right now at 10 a.m., I issue this bond. So you gave me 108,530. I am the corporation and you are the investors. You gave me 108,530, and then I do the journal entry. I record that I owe bonds payable of 100,000, and also at this moment I owe 8,530 because I got extra money from you. So let's say that's 10 a.m. By 5 p.m., 6 hours later, 7 hours later, we decide, you know what, let's just cancel everything. How much do I owe you? If like few hours later, we cancel everything, how much do I owe you? I owe you your $100,000, and also I owe you your 8,530. So both of these I owe you. It's a liability for me at this moment. We just issued this today, and right at this moment, this is a liability. But however, every 6 months that we go forward, this liability that you see here, 8,530, it will be amortized. It will be amortized here, and therefore the liability goes down. Liability goes down a little bit, but I record less expense. Instead of $4,000 interest expense that I paid here, I record less expense, but because of that, I reduce the liability. I keep reducing this liability for another 9 times, and all of a sudden, the complete $8,530 liability is completely gone because I already paid you what? A lot of interest here. The reason I ask you here for extra 8,530 because I am the company and I am paying a lot of interest, too much interest. So because of that, because you're gonna get your money back as a form of too much interest every 6 months. So at the end of 5 years, you already got your money back that you paid me ahead of time in here. So you have your money back as a form of too much interest in this. And I reduce the liability little by little to the point that I have the only liability left is just bonds payable. Make sense now?
Sort of. I mean, I think I understand the mechanics of the amortizing. over the life, but I guess
Which part is confusing?
yeah, I'm just having a hard time understanding.
Yeah. So this is extra money you gave me because I'm gonna give you a lot of payment here. You don't deserve to get 4,000. You deserve to get let's say 3,600, for example. But I'm gonna give you 4,000 every year. Why I'm giving you 4,000? Because my certificates is already printed. I cannot just cancel the whole bond paperwork because all of a sudden the market interest rate is different today. Because by the time I cancel it and I print it again, the market interest rate is different. So you never, ever can catch up to the point that say, okay, today is the market interest rate this much and let's print everything today and that's it. No, it's impossible. By the time you do the paperwork, market interest rate is changing. So at this point, I am paying, as a corporation, I am paying you as an investor too much payment. And because of that too much payment, I will ask you to pay me a premium. And that premium will be returned every 6 months, a portion of it, in this $4,000 payment. And you will get your money back. So end of the day, every investor will earn exact market interest rate they deserve. No one pays more, no one receives less. So just simple as that. Okay, let's continue on the other. But now just one more thing here. This is straight line amortization. That means 8,530 divided by 10 periods. But normally GAAP says, okay, if this is like very small amount of bond, I might accept that. But in large amount of bonds, you cannot use straight line method. You need to use effective interest method, which I think we're gonna learn today. So for GAAP, effective interest method is acceptable. Straight line method normally is not acceptable unless the bond is such a small bond and the difference is such a small thing that say, okay, but again, effective interest rate is acceptable for GAAP. So here is the bond schedule of amortization. So the original bonds is $100,000. Here is the premium, and here is the total liability of the bond on the day of issue. So if I issue bond today at the premium, I owe $108,530 at this day. However, after 6 months, if we use straight line amortization, the interest expense will be only $3,147, which is coming from this calculation. Okay. And I'm going to amortize that, record that as an interest expense. And the difference of 3,147 minus 4,000, which is 853, that will be deducted from the premium. So 8,530 minus 853 will be 7,677. That means at the end of first 6 months, this is my bonds liability. At the end of a year, first year, that's my bonds liability. So this premium will get amortized all the way zero to the point that at the end of 5 years, my bond liability is exactly $100,000 net book value of bonds payable, 100,000, and that's when I pay off my bond. So this is a table for you to look at. So let's say if we issue this in 2021, 2 years down the road, yes, 1 year and 2 years. At the end of 2 years, my bond liability is 103,412. 103,412 here, 103,412, which is bond payable plus premium that I owe you. as an investor. At the end of year 4, it's 100 plus 1,706, which is here. End of year 4, 1,706. So right there. At the end of year 5, it's just 100,000. So this is what shows in my balance sheet every year. Bond issued at discount is, that means the market interest rate is higher and the bond is paying less interest. At that time, you ask the investor to, to give you less money. And I believe we calculated that here. It's $922.78 for every $1,000. So that's $92,278 cash collection. Bonds payable will be the face amount of 100,000, and we got less money from investors, and that will become a discount. Normally, you might say, oh, why you don't recognize this interest expense right now? Because you just let the investor keep the interest in their pocket ahead of time. Yes, that's prepaid interest. So in this moment, I am not going to record all the interest that belongs for the next 5 years today. I'm going to record this as so-called discount on bonds payable. And then later on, I will amortize it and I will recognize a little bit more interest expense every 6 months. So here is every 6 months, as you see. So here I will recognize that I'm gonna pay $4,000 no matter what, but I'm gonna amortize my 7,722 divided by 10 straight line method, which I said is not accepted by GAAP anyway, but for now it's just to warm up. So it's 772 every 6 months. That's why my interest expense will be, instead of 4,000, will be $4,772. So instead of recognition of interest expense at once in here, which is absolutely bad idea, here I'm going to recognize interest expense, little by little every 6 months. So instead of 4,000, I will recognize 4,772. And then bonds payable will be closed at the end of 5 years of maturity. Questions, please? Okay, so, and if you look at the bonds payable under discount, so the discount will be less. So bonds payable, and this is how you remember discount, less is the same thing, right? So remember that way. So if you have a bonds payable and you have a discount, then that it is a less. Discount is less. So less the unamortized discount of whatever it might be at that specific time period. And that will be your bonds payable liability at that moment. So at this moment, technically my liability is just $9,639 because I got some unamortized discount still in my schedule that I need to amortize. So here is the schedule again. Your bonds payable is always 100,000. Unamortized schedule will be amortized piece by piece, and that's $7,722 at the beginning, but it will keep going down all the way to become zero. And my net book value at the beginning was $92,278, which is that at the very first day. However, that $92,278 keeps going up and up and up and up all the way to 100,000, and that's where the maturity date is, and I will pay off the liability. And interest expense, as you see every time, instead of $4,000, it will be $4,077 $4,772.20, and that's same thing every time. Okay, now this is where the gap says, I don't like that straight line method because it's not reflecting the true interest expense for the bond. So it's better to use effective interest method because for big amount of bonds, there will be significant difference in regards to how much interest expense the company is going to recognize every year. So effective interest method is a preferable method for amortizing premium and discounts on bonds. Interest expense is a constant percentage of the bond ever-changing carrying value. So the interest expense will be calculated based on bonds constantly changing carrying value for the year that you are providing financial statements. So let's look at the premium example here. So in this premium example, as you see, the bond at the beginning, it was $108,530 at the premium. That was the beginning book value. And the interest expense for effective interest method is whatever it is, $108,530 times 6% times 6 out of 12. That means 3%. So 108,530 times 3%. That is the interest expense that we actually need to recognize. But we're gonna pay people $4,000 no matter what. So 4,000 minus 3,255, it gives premium amortization of only 744, and 744 minus 108,530, it becomes 107,785. Then we take the 107,785 to the next line for the second part of the year one, then multiply that by 3% market interest rate. That gives us 3,233 minus 4,000 gives us 766. 766 minus 107, it gives us 107.19. 107.19 goes to the year two, first 6 months. 107.19 times 3% is 3,210 minus 4,000, it's 789 for premium amortization. 789 minus 107, it is 106. And you just keep doing that all the way down. So at the end of the period, net book value ends up to be exactly 100,000. The premium amortization, it is less amortization at the beginning, only $744. And that amortization keeps going up and up and up and up and up and up, all the way to $970 of premium amortization in last year. And the interest expense, it was the first year was just $3,255 out of the $4,000 payment, but keeps going down and down. So the interest expense is going down because the book value, net book value is going down. So because the net book value is down, then the interest is down. So interest at the beginning will be higher interest expense to recognize for the corporation, but down the road, it will be less interest expense to recognize for the corporation, even though the corporation is constantly paying the same $4,000. And this is effective interest method based on effective book value of the bonds every year, which is constantly changing. And that's acceptable by by GAAP. Any question on effective interest method? And then using this schedule, you can provide the journal entries at the end of each period. So in this period, let's say 8,160, this is 2003, middle of third year. Middle of third year, so in middle of third year, like that one, my interest expense should be only 3,162.51. So here we go. Interest expense is 3,162.51. I know I'm going to pay $4,000 no matter what. So this box equals to that 4,000 minus this box, enter, and then 837.49. It will be a plugged in number, whatever it might be. And that's exactly here, 837.49 for the first part of year 3. Any kind of question for schedule or journal entries? And here is how you show the liability. If it's a premium, remember premium is plus, premium plus, PP, you see, premium plus. If it is discount, it's less, okay? Premium plus. So bonds payable is 100,000 plus premium unamortized of 4,579, and that's the bonds liability net book value. Here is the discount again, same scenario, but as a discount. So here is the beginning bonds value of 92,278. And you're going to pay $4,000 no matter what. Remember that. So it's constantly going to be 4,000. The book value at the beginning is 92,278 times whatever is the market. Let's say market is 10% divided by 2 is 5%. So market is 5%. 5% of 92,278. That's $4,613 of interest expense to be recognized. However, you're going to pay always only $4,000. So 4,600 minus 4,000, that's 613. 613 minus 92, 613 plus 92,278 because it's a premium. Premium is plus, right? So 613 plus 92,278 is 92,891. And okay, that's your book value at the end of first 6 months. So beginning of the first year and the middle of first year. And then you take it to the second line, the same number, 92,891 times 5% market interest rate, that's 4,644 minus 4,000, that's 644. 644 plus 92,891 is 93,536. So remember, your book value needs to increase little by little by little all the way to 100,000. Your amortization has to go all the way from 92,000 beginning all the way to end that goes to the 100. So at the end of 5 years, you have 99. After the last amortization, this 952 will be added to 99 and exactly ends up to be 100,000 at the end. Now that you have the schedule ready, then using this schedule every 6 months, you can do this journal entry. So you pay the $4,000 to investors, and the interest expense will be recognized based on whatever is in here. So this is first part of year 3. So first part of year 3, the interest expense is 4,746 interest expense. So here you go, 4,746. And the payment is obviously easy. That's $4,000 cash. So the difference will be plugged in, and we call it discount amortization, discount on bonds payable to be amortized. So that's 746.20 right there. And again, remember in the balance sheet, if there is a discount on bonds payable, discount means less. So bonds payable less discount gives you the net book value of the bond at that given moment. Any question?
Yeah, I have a question. The discount on bonds payable, that's a liability, right? But so we put it into an abnormal balance?
Discount is not a liability. Discount, remember, people didn't give us full 100,000. People gave us 92,000, right? So technically they owe us because we told them that give us just $92,000 today and we let you have this $100,000 bonds payable. So they owe us. So now, yes, the bonds liability is 100,000, but people gave us less money. And this is the portion of that money that has not been amortized yet. So if I wanted to pay off the bond right now at this moment, my liability is 95,000. I owe less. Make sense?
Yeah, kind of. I just really need to, I think, keep thinking about it. I'm struggling with it as well.
Yeah, so there is two, at the beginning, there's two ways that you issue a bond, either in face value or in discount. So here is the Excel, if you remember. So if it's market interest rate and bonds are same, so it will be issued at face value, no issue anymore. But if the bond is paying, let's say 8% and market is less, then I will ask people to pay me a premium. Why? Because my company is going to pay 8%, but the market is 6% for a company like mine. So I'm paying too much to investors. And because I'm paying too much to investors at this moment on this bond, then I'm at the moment of issuing of the bond, I will ask people to give me extra money. This extra money for me that right now I'm collecting as a corporation from people at this moment is liability. So how much do I owe people at this moment? $1,085 because they just gave it to me. But this $1,085, so any portion of this premium that I received, if it's not amortized yet, it will add it to my liability. However, in the discount area, because my bond is paying only 8% and market is 10, so my bond is no good. My bond is not paying enough interest. So at that point, I will tell to investors, don't worry, just give me $922. That's all you need to give me today. Give me $922 and invest in my $1,000 bond. Okay, so at this moment, I gave them like about $78 discount, right? Almost. So that $78 discount, if at the same day I want to just cancel the whole thing, so I'm going to say, okay, I owe you $1,000, but minus $78 discount, I owe you only $922. So I owe less. Because of discount, you owe less. So that's why here says, if you have a discount, then you owe less. Because people didn't give you that money. People gave you technically 100,000, but less 4,330. So this is all you owe to investors. They never pay you that. So you owe less. But in a premium format, you have to add it because you owe more. Why? Because you collected more. Here, you collect more money from people. If you collect more money from people, you owe them more money. But if you collect less money, and at the same given second, you owe them less money, which makes sense. Just like me and you talking, I say, okay, give me 95 bucks and I give you $100 back. I need money right now. There is a family emergency. And you say, why 95? I say, as an interest, keep $5 in your pocket. And you say, okay, here is $95. And I say, okay, in 1 month, I'm going to pay you $100 back. And you are happy, right? But at the same moment, I get a phone call and, family issues goes away. Immediately at that second, how much do I owe you? 95. You just gave it to me, right? So I just returned 95. So 100 minus 5 is 95. So that's the liability. So this is the same concept here. So yes, the original liability was 100,000, but less money that never received from investors. So I owe investors less money. Okay, here are a little bit more details about bonds issued between interest rates, bond retirements, and fair value. So let's see what's going on here. Looks like we need to read it. Let's read it a little bit. So bonds issued between interest rates are best understood in the context of a specific example. Yes. So suppose Thomson Corporation proposed to issue $100,000 of 12% bond dated April 1st, 2021. Okay. However, despite the April 1st date, the actual issuance was slightly delayed and the bonds were not sold until June. April, May, June, yeah, 2 months later. Okay. Nevertheless, the covenant pertaining to the bonds specifies that the first 6 months interest payment date will occur on September 30th, no matter what, in the amount of $6,000. Why September? Because it will be issued on April 1st, supposed to. April, May, June, July, August, September. That's 6 months. So the interest has to be paid in 6 months, which is September. 12%. Divide by half, divide by 2, which is 6%. So 6% of 100,000 is 6,000. However, in effect, the interest for April and May has already accrued at the time the bonds are actually issued, right? So 2 months already accrued, but the bonds issued 2 months late. So to be fair, Thomson will collect $2,000 from purchasers of the bond at the time of issue and then return it within the $6,000 payment on September 30th. Because they have to pay that $6,000 on September 30th, no matter what. So they will say, hey, because we issued late, we are 2 months behind. So the 2 months of interest, just pay please right now. So I give it back to you in September 30th. So this effectively causes the net difference of $4,000 to represent interest expense for June and July. And that's okay, so that's 6,000. 12% is 12 months. So they're gonna get, let's see, they're gonna get, I don't know why yours is 4,000. Ah, 4,000 for the actual months that the investors is investing. 2,000 will be for the, okay, here is it. I'm saying why how he got 4,000. It should be 2,000. Yeah, 2,000 is correct. It's showing here. 2,000 is for the 2 months, and that means investors, they need to earn $4,000 of interest for the 4 months, which is starting June, July, August, and September. So that's correct now. So here is cash collection of 102, which is $2,000 interest payable. Bonds payable is 100,000. Imagine we issue at the face value. Market interest rate and bond interest rate is exactly same. So in that case, we, instead of collecting 100, we collect 102. However, that's we record that as interest payable of 2,000 as a liability, and then at the end of September we pay them 6,000 automatically. We have to do that. So the $2,000 interest payable that we recognize as a liability will be closed, and the 4,000 interest expense will be recognized. And after that, everything goes to normal 6 months period. Make sense? Okay. So okay, yeah. Remember, here says that last payment was what? On September, right? Therefore, at the end of the year, when you need to prepare financial statements, you need, as a corporation, you need to recognize whatever happens in this 2021 needs to stay in 2021. So therefore, the December 31st year end must have a accrual adjusting journal entry for 3,000, which is October, November, December. 3 months, 3 out of 12 times 12% times $100,000 bonds. That will be interest expense of 3,000 to recognize, and interest payable as a liability for the corporation to be in the balance sheet. We leave this as a liability in the balance sheet, and then, of course, 3 months later, at the end of the March, we need to send the second check for this bond. So the second check will go at $6,000 again. The interest expense for January, February, and March will be again $3,000. But the interest payable that we recognized here already, that will be closed. So for the year 22 up to March of year 22, only we have interest expense of $3,000 for 3 months. So this is when the bond is issued in between dates in compared to annual calendar. Okay, there's other issues. It says, how about if the bond is retired ahead of time, before the maturity? So depends when it's retired. So let me read a little bit. For instance, assume that Cabano Corporation is retiring $200,000 face value of 6% bonds payable on June 30th of 2015. Okay, so June 30th. Okay, let me read the rest. The first semi-annual interest payment accrued on April 30th. So that was accrued on April 30th. The unamortized discount on the bonds April 30th was $6,000. And there was a 5-year remaining life on the bond as of the date. So we have unamortized discount still left for $6,000 balance. Further, Cabano is paying $210,000 plus accrued interest to date, which is $2,000, to retire bonds. This early call price were stipulated in the original bond covenant. The first step to account for this bond retirement is to bring the account for interest up to date. So the last payment was in April. After April, what was that? May and June. So 2 months for May and June, interest needs to be recognized because still the corporation has the bond. So they have to recognize 200,000 times 6% times 2 out of 12 is $2,000. Okay, that's the interest for $2,000. And for the discount, let's say if you do it straight line method, just to make it easy, for straight line method, the discount is 2 months out of 60 months, and that will be $200. So you need to also amortize the discount for $200. So interest payable is $2,000. You amortize the discount for $200, and interest expense will be debited. You might say, how do you know the discount has to be on the amortized always on the credit side? Because when you issue a discount to a client, remember that discount is normal balance on the debit side, just like expense, discount expense on the debit side. So if something has a normal balance of debit, when you want to amortize it, that's a credit. And interest payable, it's a liability. That's to recognize that. That's $2,000. So interest expense will be recognized for these 2 months that we did nothing after the last recognition of April 30th. Okay, so far interest expense has been recognized properly. At this point, what do we have? We have bonds payable that needs to be closed. Normal balance is credit, so we do debit here to close it. We have $2,000 interest payable here that we need to close. Okay, we debit on that. And in the bond agreement, we said if you, at this date, if you call it for maturity, you have to pay $212,000 instead of $200. So always, in the bond says, if you want to pay in advance, you have to give investors a little bit extra money. So how much? That depends on the agreement of the bond. And here it shows that you have to pay $12,000 more. So you pay $10,000 more, which is given to us somewhere here. Here. 210,000. That was in the agreement to pay the bond in advance before maturity. Okay, so 210, that's the cash that you need to pay. And also you have to pay the $2,000 here. Obviously, we recognize that. So it needs to be closed. And also we have discounts on bonds payable left over to kind of close it. The bond here says unamortized discount was $6,000, remember? But here we already amortized it for 2 months, which came from 2 out of 60 months of bond, five years bond. 5 years bond, 2 months out of 60 months, that gives us $200 to amortize. That's good enough, close enough. At this moment, we don't worry about effective interest method or straight line. We just use straight line because the dollar amount will be very limited, very small, and it's not material to be worried about anything. So $200, it's already amortized. So 6,000 minus 2 is 5,800, and that's what is left from discount. And discount has a normal balance of debit. So in order to close that, we do 5,800 credit. So 212,000, which is 210 plus $2,000 interest, and 5,800 is all given. The only thing is plug in is this number, which is you don't know till you plug it in. So you plug all these numbers in, and then this number equals 202 minus those two numbers, and that gives us 15,800. Now my debit side and credit side is equal, and this is on the debit side, and this is the loss that I'm going to recognize Normal balance for loss or expense is debit. Remember that? So loss or expense debit. So here is an extra money because I'm going to pay extra money here, right? So this is going to be end up for me as a loss. And now you might say, why a company wants to pay a bond ahead of time before maturity and get such a big loss? Because the company knows if they keep going for this bond for another 5 years remaining, you see, for the next 5 years, they're gonna end up paying a lot of interest. And they have the cash available. Why should they pay interest if they have cash available to pay off? So since the cash is available, let's get a smaller loss here instead of having bigger interest expense down the road. So they prefer to have a loss at this point and just close this bond. Any question? Okay. Here says, be aware that bonds can change in value. Remember that the value of bond is a function of bond's stated rate of interest in relation to the going market interest rate. If market interest rate rise, look for a market value decline, reflecting a lower present value based on the higher discount rate. So if the market interest rate is going up, then the present value will change and vice versa. Companies are permitted but not required to recognize changes in value of such liabilities, but normally they don't do it. It's just extra work. So entities that opt for the approach are to report unrealized gain and losses in earnings at each reporting date, and balance sheet will be revised to reflect the fair value of the obligation. But that's extra work. Again, it depends on the companies if they want to do that or not. That's extra headache anyway. But that option, it says it's available. In regards to solvency ratio, since we are talking about long-term liabilities and bonds, so debt to asset ratio, it shows how much debt you have for every $1 of asset in the company. And that's debt and asset is second, debt to asset ratio. So debt goes at the top, at the bottom goes asset. So debt divided by total asset, and that gives you a ratio. If the ratio is higher, then the risk is higher because more debt, more risk, more obligation of interest payment. So if you are comparing in your financial analysis presentation for a solvency ratio, this is a very good ratio to use, debt to asset ratio. Debt to equity ratio shows how much debt you have in compared to every dollar of equity. What's the percentage of debt into your equity? And again, if the debt to equity ratio is higher, that means the company has more debt compared to the equity financing, and more debt means more interest obligation, more risk. So again, you can compare two companies either using debt to asset ratio or debt to equity ratio. Times interest earned ratio is also a good one, which is comparing how many times more interest is earned by the company. How many times the income of the company is bigger than the interest obligation. So in order to calculate that, income before income tax and interest, so income before tax and interest, divided by interest charges. And that will give you the earning of the company and compared to interest charges and to see how many times is bigger. So if the company's times interest earning ratio is higher number, that's good because the company has more, several times more income compared to the interest obligation. That is a good one. If the times interest earning ratio is lower, That means the company has smaller earning compared to the interest obligation, and that will create more risk. Okay, let's see. There is a very comprehensive topic in accounting, which is financing leases, or so-called capital leases. And when you lease something for your corporation, there is two ways to record that. Either it's going to be an operating lease, or let's say financing lease or capital lease. Financing lease or capital lease, you can use it either way, but financing lease is more common. Before, capital lease was more commonly used, but now financing lease. After the rules of lease accounting has changed and GAAP switched to IFRS method of evaluating for leases, international financial reporting standards, and it's more now based on professional judgment instead of giving a specific number. And before, let's say it was saying under the old GAAP, it was saying if you use more than 90% of the life of the equipment, then you have to recognize it as capital lease or so-called finance lease. But now it doesn't tell you an exact 90%. It says majority. So that way, it's harder to create a scenario to skip recognition of financing lease. The operating lease is easy. Let's say in operating lease, you never record any asset or any liability. In operating lease, you just record rent expense. So you lease equipment for 7 days, and then you return it, and then you pay $1,000, and that will be equipment rent expense. That's an operating lease. But under financing lease, you finance and lease the equipment to the point that you use the majority life of the equipment. And at the end of the lease agreement, already majority life of the equipment is used, useful life of the equipment, and you have an option to buy for a very low price. And at that case, you will probably buy it. So here is how you, and that's why the GAAP is saying, okay, since you are using the majority of it, so then recognize financing lease. And companies normally, they don't like to recognize financing lease. Why? Because the moment they recognize a financing lease, they have to recognize two things. First, they recognize the asset that they are financing, which is asset, 100,000. At the same time, they have a liability for the lease for the next, let's say, 5 years lease or whatever it is. So that's another $100,000 on the long-term liability section. And because of this, doing this, asset goes up and liability goes up. And if asset goes up and liability goes up, then these ratios will be messed up. And when the ratio gets messed up and gets worse, so the company becomes more risky. The moment the company becomes more risky, next time they want to borrow something, then the interest rate will be higher. Why? Because it's more risky company. If they want to issue bond, the market interest rate will be higher for this type of company. So the companies, they don't want to mess up these ratios because then everything else will be more expensive for them. But GAAP says, don't play game with me. If you are leasing a company, an equipment for the majority useful life of the equipment, and then you can buy it for a very low price option to buy. So that's technically you are buying it. So since you are technically buying it, then please technically do the journal entry so it shows and reflects that you have such an asset in your assets portion of your balance sheet and such a liability in your liability section of your balance sheet. And here again, it's showing you the journal entry, which you pay the, let's say, annual payment for the lease, whatever it might be. And from that annual payment, there is a portion of it that is the interest expense to recognize. And the other portion is the obligation under financing lease, which is, you see here, you have an obligation of under financing lease. That liability will be amortized and will be reduced. Okay, so to the point that after, let's say, 5 years or whatever, this equipment, all the liability has been paid off, and equipment still sitting there for you in the T account. You have the asset, but free of obligation of liability. So every single time you pay a portion of it, just like home payment. If you buy a home, if you pay the home mortgage, a portion of the mortgage will become interest, and a portion of mortgage will be reduction in the principal of the liability. Same thing.